Start பண்ணிக்கலாம். Pondicherry branch and Salem branch of SIRC welcomes all of you. Now the CPE program starts. We have topic today: GST planning for year-end compliance, reconciliation in GST, and recent judicial pronouncement by the speaker CA Devam Sheth from Ahmedabad. Let's start the program with prayer.
For 2 minutes, our meeting start. 2 minutes.
வாழ்வினில் செம்மழை செய்பவள் நீயே, மாண்புகள் நீயே, என் தமிழ் தாயே, வீழ்வாறு வீழாது காப்பவள் நீயே, வீரனின் வீரமும் வெற்றியும் நீயே, தாண்டிடு நிலையில் உனை விடுப்பேனோ, தமிழன் நாடும் தலை குனிவேனோ, தூழ்ந்தின்பம் நல்கிடும் பைந்தமிழன்னாய் தோன்றுடல் நீ உயிர் நான் மறப்பேனோ, செந்தமிழே உயிரே நருந்தேனே, செயலினை மூச்சினை உனக்களித்தேனே, நைந்தாயனில் நைந்து போகும் என் வாழ்வு, நன்னிலை உனக்கெனில் எனக்கும் தானே, முந்திய நாளினில் அறிவுமில்லாது மொய்த்தனன் மனிதராம் புதுப்புனல் மீது செந்தாமரை காடு பூத்தது போல செழித்த என் தமிழே, ஒளியே வாழி, செழித்த என் தமிழே, ஒளியே வாழி, செழித்த என் தமிழே, ஒளியே வாழி.
सुप्तेषु जागृति, येष सुप्तेषु जागृति, कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः, तदेव शुक्रं तदेव शुक्लब्रह्मा तद्ब्रह्मा, तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनाद्यपि कश्चन एतद्वैता 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 एतद्वैता.
Thank you.
Now I request M. Manju Bhashni, chairperson of Pondicherry branch, to give welcome address.
Thank you, sir. Respected chairman of Salem branch, speaker of today's program, CA Devam Sheth, my colleagues in the committee of Pondicherry branch, managing committee members of Salem branch, esteemed fellow professionals, good afternoon. On behalf of the Pondicherry branch and Salem branch of SIRC of ICAI, I welcome you all to the virtual CPE meeting on GST, planning for year-end compliance, reconciliation in GST, and recent judicial pronouncements. With increased changes and amendments being made in the GST law, it becomes a bit difficult to keep track of each such change and implement the same in the right way within the statutorily mandated time frame. Although GST law provides for various compliances that needs to be carried out on a regular basis, there are certain compliances that are mainly required to be carried out on a yearly basis. Since the yearly compliances are not a matter of routine, They are more prone to the risk of non-compliance. Today, the speaker will be focusing on year-end compliances that the entities are required to carry out and the new compliances that need to be implemented from the start of the year in relation to GST. The speaker is from Ahmedabad, which is considered the pinnacle of tax planning by tax professionals. He is here today to share his vast knowledge and rich experience with us. We thank the speaker for readily accepting our invitation at short notice despite his busy. Thank you very much, sir. Lastly, we thank one and all for your participation and response. Pondicherry branch, jointly with Chengalpattu district branch, is hosting RRC at Thekeri on 6th and 7th May 22. The chairman of the SIRC, C.H. Namastan, and CCMCA Rajendra Kumar will be inaugurating the program along with other regional council members. The members may share their concern and challenges faced by them in the profession with the chairman and CCM. We have sent the invitation through email to all the members. We request all the members to register for this program. I now request the Secretary of the Pondicherry branch, CAK Ranjit Kumar, to introduce the speaker. Over to you, sir.
Thank you, madam.
Thank you.
Let me have few words about our speaker. Mr. Devam Sheth is a chartered accountant by qualification, cleared in 2016. He is into full-time practice and holds the status of managing partner at ADS Sheth & Co. He is engaged into advisory service, even performed due diligence review as a part of value-added service for his client. Further, he is also invited as a member of Indirect Tax Committee of Gujarat Chamber of Commerce and Industry for the year 2019 to 22. He is also invited member of Indirect Tax Committee of Ahmedabad branch of ICAI branch and Chartered Accountant Association, Ahmedabad. He is also invited as a member. He has been invited by Gujarat State GST Department as a speaker for training Joint Commissioner, Deputy Commissioner, Assistant Commissioner, Officer and Inspector as a part of training program. He has addressed seminars and lectures to various corporate companies in the field of indirect taxes. He has delivered lectures at various forums such as ICAI branch of Ahmedabad, ICAI branch of Bharuch, and the Gujarat Cell Tax Bar Association, Tax Advocate Association Gujarat, Bharuch Federation of Tax Consultant, Income Tax Bar Association, and the Professional Accountant Association. He has been awarded first prize in an essay competition organized by Tax Advocate Association Gujarat for subject whether it's unpreventable to reverse ITC on goods and service used entirely for exempt supplies. He is also visiting faculty at Ahmedabad branch of Institute of Cost Accountants of India. With these words, I introduce our speaker, Devam S. Sheth. Now I hand over the session to the speaker.
So firstly, Chairman of the Pondicherry branch, Chairman of Salem branch, and all the office bearers of both the branch, and all the participants. A very good evening to all of you. It's my immense pleasure and honor to be part of this webinar, and I am grateful to both the branches for inviting me to share some of my views towards the year-end compliances and the reconciliation. I'm also grateful to CA Ranjit Kumar ji for a warm welcome. Am I given the rights of sharing the screen, ma'am?
Yes, sir. Yes, sir, you can share this.
Yeah, I'm just trying.
Sir, are you able to share the screen?
Actually, I think in the MacBook there seems to be some security issues. I'm unable to share the screen currently. What I'll do is it possible if I share you on the email and if you can have it on?
Yeah, yes, sir. You please send it through.
Yeah.
Last.
Yeah. I've done it.
Okay, sir. So just try now, sir.
Okay.
Madam, what is the issue?
The speaker is not able to share the screen.
Make him as a host. Make him as a host, madam. There are two icons there. So you have to click the three dots are there at the top. So you have to click that.
1 second, sir.
Or else I've just emailed you the presentation if you can share it, because it seems that it will take some time.
Sir, please check now.
Sir, you are now the host, sir. Please check now, sir.
Yeah, meanwhile, you also get the presentation downloaded on your end.
I'll do that. I'll do that.
Can you share that presentation, ma'am?
I'm doing it, sir.
Sure.
Okay, there. You can have that slideshow icon clicked on. Okay. So the topic that has been allotted to me for the today's session is GST planning for year-end compliances and reconciliation. See, in the current practice of GST, now we have witnessed that we have almost completed 4 to 5 years of this GST law which has prevailed. In the earlier years of 17, 18 and 18, 19, we were facing a lot of hardships in order to learn the legal provisions, and make it compliant enough with the taxpayers. Because in the initial time of 17, 18 and 18, 19, even we were not readily available with all the utilities and forms which were prescribed under the law and were not available on the portal. So now it's been 4 to 5 years that all of us have been into GST, in GST touch in a way or so, maybe through a practicing chartered accountant or maybe in the industry that we are into. So we would have touched upon some or the other way the law of GST. On going through the experiences of GST, wherein we have learned a lot of about the compliances and the reconciliation. And today, the topic that I've been assigned is on compliances and reconciliation part. We have been filing returns from day one. We have been filing different sort of forms from day one. And we are in process of learning the pending compliances and the reconciliations to be done in and out. So for a practicing chartered accountant, it is very important to be aware of the fact that we are the bridge between the taxpayer and the government. We are a center of knowledge sharing between the taxpayer and the government. It is the taxpayer who is supposed to implement all these provisions of law. And it is of utmost importance that we keep ourselves updated and intimate the relevant exercise to be done on the part of taxpayers. We are being seeing that government on day-to-day basis have been amending a lot of provisions and bringing out a lot of notifications, circulars and instructions. Currently, the council is taking care of all the legal amendments and the notifications to be brought in. The days were there wherein under service tax excise, the parliament or the budget over the key responsible aspects to be taken care of. Now coming to the topic, GST planning for year-end compliances and reconciliation. Can we come on to the next slide? So before we get into any sort of compliance activity, or for that matter advisory, or for matter departmental correspondence, it is the duty of a chartered accountant to really pursue the nature of business of the taxpayers. I am of a firm view that before giving an offering an opinion or doing any sort of compliances or making any provisions applicable of law, we must ensure that we understand the business of the taxpayers well, because that is the outline that we take into consideration before delivering any of the services from the chartered accountant. So when it comes to compliances and the reconciliations, there are a lot of aspects that needs to be taken into mind only and only if you have understood the business of the taxpayer. So once the activity of understanding the business of the taxpayer, meeting the client in person, getting the knowledge, getting the modus operandi known to you, and in which sectors or which field they perform their activities, that is the real base of a chartered accountant to keep in mind while delivering their services. Can we come to the next slide, please? So the year-end compliances and the reconciliation in the current time has been of utmost importance. In 17-18, we were supposed to file our annual returns by 31st December of the following year. However, due to the technical problem on the GST portal and the various representations made by trade and industry, it got delayed, it got extended, it got notified on a later date. and it was the February 5th of the February 2020, which happened to be the due date of GSTR 9, which was the annual return. So 17-18 and 18-19 were the years, I would say the years of experience as far as compliances are concerned. If we come to the subject, the preliminary point that I want to mention with respect to the year-end compliances, as far as zero rated supplies are concerned, it is the procurement or the renewal of letter of undertaking. In 17-18, you must agree with me that the letter of undertaking is prescribed under section 16 of the IGST Act, which talks about letter of undertaking and bond. And it has to be electronically filed. If you would have observed in 7-18, we were running from one pillar to another pillar in the department to apply and avail the letter of undertaking, because it was made manual with certain conditions, and a notification was notified in the official gazette that you are supposed to file a letter of undertaking manually in those days of 17-18, where it was not available on the GST portal. So when it comes to a year-end compliance, so if we were sitting there in March 22, many of us would have been filed or procured or renewed their letter of undertaking for their clients for the coming year, that is 22-23. Now, to make the participants more interactive, I would ask one of the poser herein that if I do a zero rated supply to an SEZ or a export of goods, and then after if I apply for letter of undertaking, is it valid or not? I will request all the participants to kindly drop a response to my question that if you do export of goods or services and subsequently you file for letter of undertaking, will it be valid under the law, and will you be able to allow the exemption of not paying tax on that particular exports? Is it possible? Any random of the participants can really respond to this question. I'm waiting for the responses.
I think normally it cannot be done, sir. But in exceptional cases, I believe there is an old circular which allowed the officer to condone the post exports. It can be done.
Yeah, thank you so much for your response. So, as one of the participants have given his view that earlier there was a position which was offered by the department that you can really condone it. Currently, the practices which is undertaken by us that we ensure that our client avail the LUT before they are engaged into zero rated supply. But my view to this is that even if you do a zero rated supply for a particular financial year, and in that particular financial year, you avail the letter of undertaking, it could be pre-zero rated supply or post-zero rated supply, still the taxpayer will be available with an exemption of not paying tax for the zero rated supplies. Now coming to the second point, which talks about the reconciliation that needs to be maintained. The first part talks about outward supply. The second part talks about the ITC. The third part talks about the balances of credit ledger and cash ledger versus the balance in the books. Usually, while filing the returns, currently GSTR 1 is to be filed, Then subsequently we file GSTR 3B. But those were the days in July 17 till November 17, wherein GSTR 3B was introduced as a stopgap arrangement to file the figures and pay the taxes. In those times, we used to file 3B first, and then subsequently we used to file GSTR 1. And if we see, there are a lot of unreconciled amounts which would be observed in those times, merely of the lack of experience, or you can say the reconciliations from time to time were not maintained. See, the importance of reconciliation as far as outward supply is concerned is with regard to the dischargement of taxes under the different heads. It could be IGST, it could be CGST, it could be SGST, and for that matter, cess. In the current practice of a chartered accountant, it is of utmost importance that while filing GSTR 1 on or before the 11th of the following month, we must get the books and the statement of GSTR 1 reconciled, and then only we must proceed towards filing of GSTR 1. Those were the days wherein the client was unaware about the details that we were supposed to give to the consultant in order to file GSTR 1. Because we as a consultants are responsible for filing GSTR 1 on behalf of the taxpayers. I would say we were the ones who were supposed to learn that what is GSTR 1, how it is to be filed. So we were in that stage of learning. So we cannot expect that client would be giving the details in the format that we are asking for. So pre-consultation that has to be done before filing any of the GSTR returns. So on or before 11th of the following month, we are filing GSTR 1, which is the details of outward supplies. And before filing it, we must get the details of books with respect to the outward supply in order to avoid any discrepancies thereafter. Once GSTR 1 is filed, we come upon GSTR 3B. I must tell you, in our office, we have a practice that unless and until the outward supplies reported in GSTR 1 does not match with the outward supplies reported in 3B, we do not proceed towards filing of returns. And we ensure that we get the 3Bs from all of our clients by 15th or 16th of the following month, because we have 3-4 days of scope of improvement wherein we can really have the checks done, and then we file our GSTR 3B. I'm pretty much sure that all of the participants would be having same thought process and same sort of practices in order to avoid the discrepancies. Currently, we are been facing a lot of ASMT 10 notices from the department, and more of them are focused on difference between GSTR 1 versus 3B or GSTR 2A versus 3B. So though the compliance aspect seems to be of a low recognizable activity or work by the client, but it plays an important role when it comes to departmental correspondence. We have been seeing that clients or the taxpayers do not appreciate the work of compliances that is been done at the office of a chartered accountant. But we do know the value of these compliances, because after 3-4 years, we are the ones who are supposed to appear before the authorities and make them satisfied as far as our responses are concerned. So on month-to-month basis and on quarter-to-quarter basis, we must have our books reconciled as far as outward supplies is concerned. It may happen that some of the transaction we would have reported as B2C, but it was supposed to be reported as B2B. It may also happen that some of the transactions of credit debit note got set off under B2C transactions. So day in, day out, or month-on basis, we have to really ensure and examine the outward supplies reported in the books of accounts. Coming to input tax credit matters, ITC claimed in GSTR 3B versus ITC appearing GSTR 2A and 2B. Now, I would like to ask the participants that when do a taxpayer is supposed to really reconcile their ITC from the legal perspective been made affected in order to reconcile their ITC reported in 3B versus the ITC reflecting in 2A. So from which year the role of 2A or 2B has really come into picture to reconcile their ITC? If may I have some responses from the participants, I would really appreciate that. What was the period then after which was taken care by the taxpayers in order to really reconcile the ITC reported in 3B as compared to it was appearing in 2A? I believe that in 17, 18 and 18, 19, we had our input tax claim through the invoices or through the preliminary conditions of section 16, subsection 2. Any of the participants would like to voluntarily respond to this question, that after which period are we really supposed to reconcile our ITC with GSTR 2A or 2B? Some of them can also respond it in the chat box as well if they do not want to unmute themselves and speak. So it was 9th of October 2019, wherein Rule 36.4 that was placed in the CGST Rules 2017, which says that you can claim your input tax credit to the extent of 120% of the ITC reflecting in your 2A. So that were the dates, or I would say October month 2019 were the months that thereafter we have started ourselves to reconcile the input tax credit with the credit that we have been claiming in 3B. Though it has been, the Rule 36.4 has been challenged in lot of the high courts, but as on date, there is no verdict on the same. That is why we are supposed to follow the provision of law and ensure that the credit which are reflecting in 2A, 2B needs to be reconciled with the credit claim in 3B. In my view, 2B, which was introduced a year back, did not have any legal enforcement. However, from 1st of Jan 2022, a legal enforcement has come to an extent that in order to claim ITC in 3B, you are supposed to ensure that ITC in 2B should have been reflected. Otherwise, you won't be eligible or entitled to claim the input tax credit. So the notices that we are facing currently, which has been issued by the department, is more on the discrepancies between GSTR 2A and 3B. In my humble opinion, if the discrepancy pertains to 17, 18 and 18, 19, there is a good amount of chance to fight the case and go into litigation, because there was no governing provision to really restrict the input tax credit reported in 3B, because there was no matching concept available in the law. Rather, I would say there was no matching concept effected in the provision of law. Though we had GSTR 2 and 3, but it did not get enforced and it got delayed time and again. And in the current Union Finance Bill, even GSTR 2 and GSTR 3 is supposed to get omitted under the law. So as far as 17, 18 and 18, 19, if I talk about the cases that I'm handling currently before the department, we have gone into the litigation and we are fighting the case merely because 2 and 3 was not effective and the claim of credit was done on the preliminary conditions of section 2, section 16, subsection 2. Anyone can tell what are the conditions which have been given in section 16, subsection 2, which are the preliminary condition in order to claim the credit. Section 16, subsection 2. Firstly, it says that you must be in possession of the invoice. Second, it says that the actual receipt of goods and service should have happened. Third, that the taxes should have been paid in cash or through admissible input tax credit. And fourth is the recipient should have filed the returns. So these are the four preliminary conditions. On that basis, the taxpayers were claiming the input tax credit in 17, 18 and 18, 19. But there was some governing or a controlling aspect that came into picture as far as ITC is concerned from October 2019 with some or the other restrictions. And now from 1st of Jan 2022, we are supposed to claim the credit, what it is reflecting in 2A and 2B. So the reason why I have gone through the nuances of 2A, 2B, because it is very important for the reconciliation. If you file your GSTR 9, there is table 8A, table 8B, and table 8C and table 8D. So these are the tables which are really inviting trouble for the taxpayers, and the department is using that as a tool to issue the notices. Now the third point that I'm talking about is balance of credit ledger and cash ledger versus the balance in the books. The credit ledger talks about the input tax credit, which is getting credited in the credit ledger, and cash ledger is something that we pay it through the challan and deposit that cash into the portal. The important aspect to this, earlier as per section 49, which talks about payment of taxes, and there is also rule 88, which talks about utilization of input tax credit. Now, why this is important? Because earlier the credits were offsetted in a terminology manner in a given modus operandi. Then after it got amended and a new utilization manner was prescribed. So currently, as on date, the mechanism which has been given in the law is that if you have liability under any head of the law, the credit available under IGST needs to be exhausted first before utilizing any other credit under CGST or SGST. So unless and until your IGST head is not exhausted, you won't be able to utilize the credits lying in CGST and SGST. So the similar utilization or the general entries needs to be done in the books of accounts as well. The question is not that the balance lying in electronic credit ledger is 1 lakh and we also have the balance in our books amounting to 1 lakh. The question is the credit of 1 lakh apportioned under IGST, CGST and SGST should have the similar entries in the books of account as well. If you have 20,000 in IGST, 40,000 in CGST and SGST, you also have 40,000. So that amounts to 1 lakh. This is the available balance on the credit ledger. So in books also, you must ensure that the credit balances lying under the head should match. It should not happen that IGST is having 30,000, CGST is having 40,000 and SGST is having 30,000. Though the balance is at the end remains 1 lakh. But why do we have to do the reconciliation? Because the utilization manner prescribed in the law needs to be applied. And the entries which have been posted in the credit ledger and in the cash ledger, the similar entry should also appear in your books of accounts. Now coming to a very, I would say, very frightening part of GST, that is e-way bill. The participants would agree with me that currently, while conducting any scrutiny or conducting any audit of the taxpayer, we are least concerned with the reconciliation of e-way bills. The mere reason that we do not reconcile the outward supplies with e-way bills is because the voluminous transaction that we come to know from the client's mouth, on the very that moment, we drop to really examine the e-way bill. Because this being an year-end activity, we need to make aware the client regarding the importance of the e-way bill, the crux of the e-way bill, because these e-way bills are the ones which helps as a tool from the department's end to really scrutinize your books of accounts. If you show that in your books of accounts you have 100 CRs of outward supply, and out of 100 CR, you have only generated e-way bills of 80 CR. So they may ask you that, how about 20 crore? Where have they gone? What is, kindly explain the differences which has amounted to 20 crores. It may also happen that some of the transaction would be X works, wherein the customer would have come to your place and would have taken the delivery. So in that case, you would not have generated the e-way bill. It may also happen that you would have engaged yourself into a bill to ship to transaction where there are 3 parties, but the goods would have moved only once. So you must have the reasons aligned with you that out of the outward supply made of 100 CR, I have generated e-way bills of 80 CR, and you must have the reasons of the differences. Otherwise, it is very easy for the department to really allege that for the 20 invoices, the 20 crore outward supply, there is no e-way bill, and we believe that there is no movement of goods have happened and there is no delivery of goods that have taken place. This will create an angle and will lead into a litigation where they may have the reason that you have only raised the invoices and not delivered the goods. So I would really try to focus on this particular aspect, that we must have the reconciliation of the e-way bills versus books of accounts. Currently, I know that this being a voluminous part of activity, we may be dropping due to paucity of time. We may not be really looking up to this reconciliation, but this reconciliation will really create a trouble for the taxpayer. And if the taxpayer gets into trouble, then consultant will also get into trouble to really defend this case. Next slide, please. So if you remember, long back in December 20, a law was, I would say a provision was introduced that Rule 46 governed the issuance of tax invoice, and it was replaced by e-invoice if you have the turnover exceeding 500 CR.
I didn't get that. Could you try again?
And then after it lowered down to 100 CR, then after it lowered down to 50 CR, and from 1st of April 2022, we have witnessed that e-invoice is applicable to those registered person who exceeds their aggregate turnover, which has more than 20 CR. So my point here is that if the registered person is applicable to generate e-invoice, and if it does not generate e-invoice and simply issue tax invoice and give it to the recipient, this will create lot of trouble. This will create lot of hardship on the recipient end. Because if I recollect section 16, subsection 2, clause A, which says that there should be possession of tax invoice. Now, the rule 46 of tax invoice got amended, and the registered person is supposed to issue e-invoice. If a supplier does not issue e-invoice, the recipient be in danger of not getting the credit because the recipient is not in possession of a legitimate document under the law. So, as a chartered accountant, as a practicing chartered accountant, it is our duty to really ensure and make our client informed that you are supposed to generate e-invoice. Ensure you generate e-invoice and deliver it to your recipient, because that is the document that will be taken as a legitimate document to claim the credit for the recipient. Now, what I have observed while dealing with the clients or the clients with whom I am been engaged into consultancy and advisory matters, they have been only issuing e-invoice as far as B2B transaction is concerned. We all know that for B2C, e-invoice is not applicable. We also know that for exempted supply, e-invoice is not applicable because we have to generate bill of supply. But for the credit notes and the debit notes connected to B2B transaction, even in that case, e-invoice is compulsory. I am been seeing a lot of cases from 2021 that people have failed to generate e-invoice for the credit notes and the debit notes in reference to the original B2B transaction. So you must all take a note of it that e-invoice is applicable to B2B transaction, credit note in reference to B2B transaction, debit note in reference to B2B transaction, supplies to SEZ unit or developer, and export of goods or services. So ensure that your client raises the legitimate document which will really carry the importance for the recipient, because that is the document of claiming the credit. Now, a lot of time while conducting audit, while filing 9 and 9C, we are not really looking upon of the provision called time of supply. I'm pretty sure that while conducting 9 and 9C, we only look after 3 crucial points. One is outward supply, second is input tax credit, and third is reverse charge mechanism. And we only really roam around on these 3 particular aspects, and we file 9 and 9C by reconciling it. But the important aspect, which is time of supply, we are not really coping upon or really understanding the terminology of time of supply, that in what timing we are supposed to raise the invoice, when are we supposed to discharge the tax. This is something that we really need to perform while conducting this activity, because this will really help us as a chartered accountant and it will create a value addition to the clients. So I must suggest that all the participants, while conducting some of the other sort of due diligence or audit, they must also look into time of supply. Because as far as advances are concerned, in goods, it has been, I think it has been stopped from 15th November 2017, whereas as far as services are concerned, it is still going on, that you are supposed to discharge the tax on the advances received for the services. Now coming to the debit credit notes, section 34. Can anyone tell me that what are the 3 scenarios where credit note is available to be raised under section 34 by charging GST? So what are the real conditions or the criteria that a taxpayer can really raise the credit note with taxes? And this will lead into reduction in the output liability for the supplier and reduction into the claim of input tax credit for the recipient. If anyone want to volunteer to respond this question, I will also appreciate if you can drop in the responses in the chat box as well. So if we crucially read section 34, it says that if in case you have charged excess tax or taxable value, you may raise the credit note. Second, if there is a goods return. And third, if there is a deficiency in services. These are the three categorically mentioned reasons for which credit note can be raised. Otherwise, any of the credit note raised for the unknown fourth reason, which is not part of the law, will be questioned and may not be available with the reduction of the liability. Section 34 also focuses upon that if you have raised the tax invoice of 100, having a tax of 18, and now you wish to raise a credit note of rupees 20 and you want to reduce your liability on 80, you have to also take and ensure that the recipient does not claim the credit on 100. The recipient also needs to reduce the claim of credit to 80. So for that matter, I would suggest that we must suggest our client or recommend that while raising the credit note to the customers, kindly get a undertaking from the customer that they have reduced the liability in their books of accounts. I would say they have reduced the claim of input tax credit under books of accounts, because government is getting the tax on 80, whereas recipient should also claim the input tax credit on 80. So in order to create a proper par as far as claim and dischargement of liability is concerned, this needs to be followed. And the reduction in the liability will be only be entertained by the department if the recipient have reduced the input tax credit to that extent of credit note. Now you have seen that there is also time limit for raising the credit note, that it is up to the next month of September. But if you see for the debit note, there is no time limit. So what the government intentions are, that in order to discharge more and more liability, we do not want to bring any of the hurdles for the taxpayers. You go on raising debit notes, we go on recovering tax from you. But as far as credit note is concerned, which leads into reduction into the tax of government, in the reduction into recovery of the GST by the government, they have put in a clause of that you cannot raise the credit note after the following September. Eligibility to claim the refund. Lot of times that we come across that the taxpayer is entitled to claim the refund either under LUT or with payment of IGST. But during filing of the returns, there are some of the other mistakes or error that we really observe that leads into a difficult part to claim the refund from the department. So at the year end, we also need to ensure that we do not miss any of the deadline of claiming the refund as per section 54. That whether 2 years have been lapsed as far as section 54 is concerned. And at the year end, we also need to ensure that are we eligible for any of the refund that I have made against, that is against the zero rated supply. Was there any excess payment of tax? Whether any cash payment is lying in the electronic credit ledger? Whether the dischargement of IGST on export have been refunded and credited into your bank account? We need to ensure that merely filing returns is not sufficient. We have to also ensure that the IGST paid on the zero rated supply should have been also credited to your bank account. So for that particular matter, we have a practice that while filing GSTR1, we verify the shipping bill for the exports made. where there is a payment of IGST. We get it verified on the ICE gate, and after verification, we go on and file the GSTR 1. So the transmission of the data on the ICE gate portal is smooth enough. Coming to the determination of tax liability against the receipt of advance and adjustment, which is required in order to derive the unadjusted advances. So before filing the return of March, we must calculate the advances received from April to Feb and any adjustment that needs to be offsetted against these advances. Then after we'll be able to derive the value of unadjusted advances on which the tax is supposed to be paid and remains unadjusted for the amount which will have the invoices raised in the subsequent year. So under GSTR 9, there is table 4. We have a column which talks about unadjusted advances. So if you have paid advance on 100 and you have raised the invoice of 80, so at the end of the year, you have 20 rupees as an unadjusted advances which needs to be reported in your GSTR 9. And that 20 rupees will have the invoices raised in the subsequent years. Now coming to the job work. Even this has a very crucial aspect to the compliance, because what I have seen is a lot of companies are failing to really file ITC 04 merely because there is a lot of information being asked by the department or the forms that have been created on the portal. Because if you see the VAT law, we were supposed to file the stock statement at the end of the month or while filing the returns. In GST, we do not have any such requirement. But in order to track the movement of goods, that as a manufacturer, if you have given any goods for job work, how long it has been out, whether it has come back within the prescribed time as prescribed in section 143 or not. For that matter, they have come out with ITC 04, which needs to be filed quarterly. And even they have come out with an exemption that if your turnover is below 5 CR, then you may file it on half-yearly basis. So if you have any of the expenditure as a job work expenditure in your profit and loss account, kindly verify that whether ITC 04 has been filed or not. While conducting the audit, you may be also scrutinizing the expenditures. And if you find any of the expenditure with reference to job work, you also ensure that their ITC 04 also needs to be filed. Next slide, please. If I can request if the other participants, one of the participants needs to unmute, mute them themselves. I think. Okay, now it is on. Madam, can we come to the next slide? So meanwhile, can I come to know as far as the slides that I have explained, do we have any sort of queries currently, or shall we take the queries at the end?
So we can take the queries at the end.
Okay, no problem. So coming to claim of input tax credit on the legitimate document, I would say this is the most revenue generating aspect for the department. Most of the times, the taxpayers have tried to comply themselves for the dischargement of outward supply. But input tax credit is something that usually had a phase of litigation before, currently also, and in future also it will stay. Because input tax credit is something that a benefit has been granted from the government, which is taken by the taxpayer. And it is always that if a benefit has been conferred by the department, that needs to be challenged. Because as far as outward supply is concerned, they are recovering the amount of tax. Whereas input tax is concerned, it is the benefit that we are being availing from the government. And they will ensure that none of the benefit should be go unexamined. Now, Rule 36 has a direct reference to Section 60 subsection 2. 16 subsection 2 says that you should be in possession of the invoice. Now, if we come to rule 36, which talks about that which are the list of documents that needs to be in possession to claim the input tax credit. So while conducting a year-end compliances, or for matter while conducting the audit as well, we are not really looking after the document. We have stopped examining or reviewing the documents. Merely it reflects in 2A. It is not so that you will be given the credit. What if the government officer asks that these are the 100 invoice which are reflecting in 2A and the total also matches with the credit reflecting in 3B, you kindly produce me the documents. And if any of the document is missing, they will deny the credit, because the parent provision with its section 16 subsection 2 talks about you should be in possession of the invoice. If you are not in possession of the tax invoice, even if it is reflecting in 2A, you will not be granted the credit. So it is very crucial to really examine the document. Though we do it on a sample basis, but we must really examine the document. Because a lot of times while conducting the audit or while conducting the year-end aspect, we wait for the audited balance sheet or the provisional balance sheet, and then after we start our work. Usually what is the practice? That in order to file GST 9 and 9C, we wait for the taxpayer to really give the audited balance sheet, and then after we really work upon it. The day on which the taxpayer gives you the balance sheet and the day on which you are supposed to file 9 and 9C, you hardly get a month or 2 months or 3 months, not more than that. And in 3 months, you are supposed to file 59 9C or 109 9C or 209 9C. So 2-3 months are not enough to really undertake this activity. So as a chartered accountant, the value addition that we bring to the taxpayer is quarterly due diligence or quarterly health checkups of the clients. So on quarterly basis or on monthly basis, we really freeze their data and really examine the documentation. So we must not waste for that once audited balance sheet will be received, then after we'll conduct the activity and then after we'll examine. And due to the paucity of time, we really run after and hurry up in filing 9C, and then after filing it, we really realize that these are the things that we have missed up. And that missed data will only create troubles while doing the assessment. So for ISD credit, the ISD invoice is necessary. An invoice issued by the supplier as per section 31 that talks about tax invoice. B is about RCM self invoice. I'm pretty sure, or I would say in a lighter mode, that none of our participants or none of the practicing chartered accountant would really check whether self invoice has been generated or not. Though it is one of the requirement under the law that self invoice is required to claim the credit. Currently, what practice we do, we report it in the GST returns, we take the credit. We report it, we take the credit. We report it, we take the credit. But in order to claim the credit, the document is important, and we talk about self invoice. If you do not have a document and merely you have paid the amount and taken the credit, they may take up a point that you do not have any documentation to claim the credit. We may argue in a way that, sir, it is just a procedural lapse that can be really taken after as well. But even why do we give a point to the department in raising this allegation? If we are already aware about the fact that self-invoice is required, then why don't we really implement it? Then coming to debit notes, the debit note should be in line with section 34. Bill of entries in order to claim the credit for import of goods. Next slide, please. So these are the transaction that we really observe while having a related party transaction. Schedule 1, which talks about that activities which are called as supply, but there is no consideration. You purchase a capital asset, you claim the credit, you sell off that particular capital asset by not charging the consideration, credit needs to be reversed. That particular transaction will be termed as supply. Transaction between the distinct parties, transaction between the related parties without consideration will be termed as supply. Irrespective of whether you pay or not, the transaction is taxable and relevant taxes needs to be paid. Usually, what we see that stock transfer that happens from one state to another is one of the transactions that is falling under Schedule 1. There is a supply from one state to another state, which is distinct persons under the law because they have distinct registrations, and the consideration is not involved, even though this will be termed as a deemed supply under Schedule 1. While observing or examining profit and loss in outward supply, you may not see this turnover because it is an inter-division sale or inter-division purchase. But you need to additionally add this transaction in order to determine the GST liability. So when you are doing an year-end compliances, you have to also ensure that whether any transaction which is not reflecting in profit and loss account but has taken place between the distinct person or the related party, that also needs to be taxed. So you do not avoid paying the taxes on that and you do not miss on that part. There may also happen that you have a premise, and on that premise, it is under the ownership of one company. And you may also observe that there are other 20 companies which are registered on that same premise. So while doing the registration of private limited or limited company, you may be giving that NOC while getting it registered. But as far as GST is concerned, you give them NOC or do the rental agreement, GST is leviable because A Limited is under the ownership of a property and you have B Limited which is also registered on that particular property. In that case, A Limited needs to recover the GST from B Limited on the notional amount if you are giving it on an NOC, or you deal into a rental agreement and fix a rent for a month and then charge GST accordingly. The valuation will not be a question because under Rule 28, it says that if the recipient, which is B Limited in the case, is eligible to claim the full credit, then the value reported in the invoice will be deemed to be an open market value. So if the rates of the rental going on in that area is 50,000 per month, and even if you charge 5,000 per month to B, even that 5,000 will be open market value and will be unchallenged under the law. Schedule 2, which is the classification of supply. Can anyone tell me that merely the activity falling under Schedule 2 will be deemed to be a supply? Whether activities classified under Schedule 2 will be deemed to be supply under Section 7? Can anyone tell me? So Schedule 2 got amended because earlier that got a deeming fiction that any activity listed in Schedule 2 will be deemed to be a supply and will be deemed to be classified as good or services, either ways. But it got amended. It said that Schedule 2 is only for the purpose of classification and not for determining whether it is a supply or not. In order to classify whether the activity is goods or services, that it needs to be a supply in the first place. If it is not a supply under section 7, then schedule 2 will not come into picture. So while identifying any transaction, that whether it is goods or services, ensure that there is a supply first. Classification of HSN on service accounting code, very important, because for goods, the different HSN, there are different rates. So ensure and recognize the HSN and accordingly recognize the rates. The thing that I have observed, that on the year-end compliances, we must also revisit the rate of the tax. That earlier the taxpayer was paying 18%, and now due to some or the other amendment, it has gone down to 12%. So we must revisit the HSN code. We must revisit the classification, which will help us to determine the actual rate of dischargement. And similarly for the service accounting code, identification of place of supply. Section 7, Section 8, Section 10, 11, 12, and 13 of the IGST Act. Ensure that whether you have paid the correct taxes under the correct head, you have not paid IGST where it was supposed to be paid as CGST and SGST, and vice versa. Valuation of supply in accordance with the provisions. Section 15. Ensure that whether any expenditures which have been recovered from the customer are that expenditure were to be part of the valuation or not, whether that amount is as against the pure agent services, whether any additional amount recollected needs to be part of the value, and accordingly tax needs to be discharged, because it will create the charge of interest on the delay payment of tax. So valuation is also very important, and whether it has been done on an open market value or not, if there is a relation between the parties. Because unlike excise, under GST section 15 is very much clear that whatever amount that you charge on the invoice will be the transaction value and will be unchallenged if it is with a unrelated party, and where price is the only sole consideration. Compliance of job work procedure that we discuss about, that within inputs needs to be received back in some period, capital goods needs to be received back in the periods. Otherwise, if it does not get back into the due time, then it will be deemed supply. So apart from filing ITC 04, we also need to ensure that inputs and capital goods needs to come back within due time. Because when you are getting out the raw material, the tax is not charged, and you do not get the material back in time, then it would be a deemed supply under the law. And next slide, please. Health check of GST returns and its reporting, that B2B or B2C or credit debit note or export, whether necessary amendment needs to be made in due course of time. You file the GSTR 1 inadvertently by mistake, and you want to really amend that particular transaction or part of it, you need to do it in the very next month, or you get a time period as per section 37 up to the month of September. So ensure that all the returns which are required to be filed are filed, and the reporting that needs to be made are made in due course. Because it also happens that while discharging the liability under RCM, you got a service from a person who is located outside India, and you have paid the RCM and you have claimed the credit. So that claim of credit needs to be reported not with the other RCM, but it needs to be reported under the head of import of service. I have also observed that the credit of import of goods needs to be mentioned in the column import of goods. But many of them, what I have observed, that they are claiming the credit with in all other ITC column. So proper reporting needs to be really carried out, which will really help during the adjudication processes. Validation of RCM liability. We have observed that there are a lot of RCM supplies which have been notified under 9 subsection 3 of CGST Act, section 5, subsection 3 of the IGST Act. And we had RCM on the unregistered supplies up to 13th October 2017, which was 9.4 and 5.4 of the respective acts. While filing the returns of the closing month of a financial year, all the RCM liability of a particular financial year needs to be reported and the dischargement of tax needs to be done accordingly. There are transportation services, advocate services, sitting fees of a director, security service, rent-a-cab services, ocean freight services, though that particular matter is sub judice as the matter is pending before the Supreme Court. The argument from revenue and the petitioner is completed and the order is reserved. And for goods also, we have some tendu leaves, cashew nuts, raw cotton. So these are the items on which the ITC needs to, the RCM needs to be paid correctly with the correct rates and under the correct head, and then claim the ITC. ITC claimed for RCM shall not be more than what has been reported as RCM liability. If you are paying 100 rupees as RCM liability, your credit should not exceed 100. It may happen that you have paid the RCM liability 100 and you would be claiming 80 or 90 or 75, because claiming of credit is on the discretionary of the taxpayer. For example, rent-a-cab service. From a non-body corporate to a body corporate, RCM is applicable. You pay the tax, but under section 17 subsection 5, the credit of rent-a-cab is not available. So you may be paying the tax under RCM on the rent-a-cab services received, but you will not be claiming the credit. So the RCM credit should not be more than the RCM liability reported. Moreover, RCM reported in two-way. So this is also very important in my view, that you may be reporting or putting down your entries in the accounts, but it may also happen that you would have missed some of the entries that can be identified in two-way. If you download the two-way of a particular taxpayer, at the end you also get to know that who all are the suppliers who have reported their transactions under RCM on which the recipient was supposed to pay the tax. So this identification really helps you if you have missed out some of the RCM which needs to be paid. So from GSTR 2A also, you can really identify some of the transactions wherein the suppliers have reported that these are the transactions on which the recipient is supposed to pay the tax, and then accordingly you really comply it. Appropriate payment of interest on delay payment of tax. So now things are very much clear with respect to the interest on the output liability, that it will be on the net portion of the cash payment and not on the gross liability, because it got amended from time to time, and on June 2021 it got settled that the interest needs to be paid on the net portion of the liability and not on the gross portion of the liability. Though there is an exception that if your matter is getting adjudicated under 73 or 74, and once the adjudication has been started and then after you start filing the returns, in that case you may not be privileged to get the exemption of paying the interest on the net. Claim of TDS and TCS, if you are doing the transaction through electronic commerce operator, or if you are dealing it with some of the government or government organization, they would be deducting your TDS or TCS that needs to be appropriately claimed by filing the returns, and this particular deduction will be credited to your electronic cash ledger. Either this cash ledger will help you to offset your liability towards the outside supply, or you can claim the refund of it. Next slide, please. Requirement for ITC reversal or to be reclaimed. So these are some of the rules which talks about that once you have claimed the ITC, now it is the time to pay it back to the government. ITC reversal on account of non-payment within 180 days or reclaim of ITC in respect of supplies for which payment is made. So it is a given fact in proviso 2 of section 16 subsection 2, which says that if you fail to make a payment of the value and the tax to the supplier within 180 days from the date of invoice, you need to reverse the credit. I have some of my reservation to this particular proviso. It says that if you fail to pay, if I'm already dealing with my customer, rather I would say if I'm already dealing with my supplier, that I will pay you after 240 days or after 300 days, that is the contractual agreement with the supplier. Law cannot enforce me something that is beyond the contractual agreement with the supplier. Further, it says if you fail to pay, what does fail to pay means? That you are supposed to pay and you didn't pay. If I have an agreement with my supplier which says that on 200 day you are supposed to pay the amount, and if I'm not doing so, that is called fail to pay. Hope you are able to understand what the phrase fail to pay means. I was supposed to and I didn't. That is called fail to pay. But if it is already decided that on this day I will make the payment and I'm doing it, then it does not make a fail to pay phrase implemented. A supplier issuing me an invoice of 100, and if I only pay 90 after negotiation, is raising me an invoice of 100 plus 18%. I am paying him 90 and tax according to 90. So I'm paying him 116 as compared to 118. Then after negotiation, this has happened. Then the phrase fail to pay will not come into picture because I was only supposed to pay him 90 plus tax as it was renegotiated with him. Now the question that comes up that whether I'll claim the credit on 100 or on 90 if the supplier does not issue the credit note. If supplier issues the credit note, it is what always the recipient reduces his ITC. But if supplier pays tax on 100 and I am paying him only 90 plus tax to him, whether the recipient will be eligible to claim the credit on 100? In my view, the recipient will be eligible to claim the credit on 100, though he is only paying the amount 90 to the supplier. What the government want to ensure that whatever amount that is getting deposited to their treasury, the benefit should not be more than what has been deposited in their treasury. If the outward supply has been reduced from 100 to 90 and still I am claiming the credit on 100, then it is incorrect. But if the liability has been discharged on 100 and I am paying the supplier 90 and there is no reduction in the outward supply from the supplier's part, even then also the recipient will be eligible to claim the credit on 100. So this is my personal view to this. Now, Rule 37 currently is non-operational in my view because it says that the reversal of ITC needs to be done in GSTR 2. If you are not paying the tax within 180 days, the reversal needs to be done in GSTR 2. And currently GSTR 2 and 3 is non-operational. So to have the effect of this particular rule, there needs to be GSTR 2 in place. But for the purpose of peace, the taxpayer may undertake this exercise and reverse the credit if it is not paid within 180 days and reclaim it once it is paid. So in order to have peace with the department, you may follow this rule, and for the practical conveniences, you may reverse the credit and reclaim it accordingly. Rule 40 to 43, everyone knows there is a section 17.2 and 17.3 which talks about that if you are engaged into exempted supplies, then you are supposed to reverse the input tax credit as per the rules. So after the end of the financial year, or I would say in March itself, you must really carry out this exercise. Though the rule 40 to 43 says that this reversal needs to take place on month-to-month basis, or I would say tax period to tax period basis. But if you have failed to do so, then you may ensure that it is done in the March. Though they have given a period up to September of the following year, but it is better that we do not have any spillover effect of a particular financial year into the next financial year. Rule 40-44, as far as supply of capital goods is concerned, that if you purchase the capital goods within 5 years you sell it off, then there is some of the proportion 5% per quarter needs to be reversed for the non-used period of life of 5 years. So if you have purchased it today and within 2 years you have sold it, then to the extent of 3 years, you need to reverse the credit. And other ITC reversal in terms of section 17 subsection 5. Everyone knows that there is a clause of block credit under the law. And if in case you have claimed that credit, you kindly reverse it. Currently, there has been a proposition by the government that you have claimed any ineligible credit and you have not utilized it and you reverse that credit, then no interest will be leviable. Section 73 and 74 has word wrongly availed or wrongly utilized. But a clarification has really come into picture by the government that if you have claimed any ineligible credit or credit which was not available to you, but if you have not used it and you reverse that particular credit, then interest will not be leviable. So it is better that we identify if in case any block credit has been claimed, that needs to be reversed immediately. Examine GSTR 9 and 9C. Why I am focusing upon the earlier 9 and 9C? Because if some of the transactions of the earlier period you have reported in GSTR 3B or 1 in the current year, that also needs to be reconciled in order to reconcile the current financial year. That out of the reconciliation, there are some of the transactions which pertains to the earlier period which got reported in the current year. Then that particular transaction needs to be ignored for the reconciliation of the current period. Next, cross charge and input service distributor. I would say ISD is something that we have witnessed or observed while we were practicing in service tax, that the credit gets accumulated on the head office and it has been distributed to various branches. So I've given an example that ABC India has 3 supplying units at Delhi, Chennai and Calcutta, and there is an head office in Maharashtra. So ABC India can avail all the services at Maharashtra as ISD and distribute the same to the various supplying units under ISD mechanism on a turnover basis. So any of the services which are availed by Delhi, Chennai, Kolkata, and it got invoiced at ISD level, then they can distribute this credit with the mechanism prescribed and they can distribute this credit to various units. Usually, bank charges are one of the services which gets distributed through ISD, because ISD itself do not have any outward supply. The purpose of obtaining an ISD is to distribute the credit which got billed on the ISD address for the services really availed by the branches, or I would say by the units. Whereas cross charge is something, as far as ISD is concerned, I want to mention one point, that it is only a one-way effect. It is only the ISD that really distribute the credit and it is not a vice versa. Whereas under cross charge, there is a flexibility that from HO to the branches and branches to the HO, you can really have a cross charge effect, and you can really invoice it between the distinct person. So cross charge is something which is flexible, and ISD is something I would say rigid as compared to cross charge. So in cross charge, I have given an example that if ABC has a plant in Maharashtra, but the representative office is at Delhi, Chennai, Kolkata, and Tamil Nadu, which is only engaged into marketing activities. So any of the supplies which have taken place at the marketing activities, the credit is getting accumulated at that marketing places, because they do not have any outward supply with these locations. So what they can do is the credit which have got accumulated at Delhi, Chennai, Kolkata, Tamil Nadu, that can be cross-charged as a business support service to their plant which is situated in Maharashtra. And on similar ways, they can also have a vice versa effect to it. That for Delhi, Chennai, Kolkata, and Tamil Nadu, any of the services which are billed to Maharashtra, they can really distribute it. But that distribution or the cross-charge will only happen because it will only make sense if Delhi, Chennai, Kolkata, or Tamil Nadu has any outward supply. If they do not have any outward supply, then there is no sense of distributing the credit to the branches. Next slide. Next slide, please, madam. So for the compliance part, this is the last slide at year-end compliances. We must recognize the line items in our trial balances. That what are the line items which carries the importance under the provisions of law. That what all line items can be affected by the provisions of law, that needs to be identified. This exercise is important because even the department officers, before starting or conducting their assessment or their audit, they will ask for the trial balance of the taxpayer. And from the trial balance, they identify the line items and will pose a question or will create a demand on the taxpayers. So merely having a reference to sales account or purchase account or expense account will not be sufficient for us to discharge the liability or for that matter to avail the input tax credit. We must scrutinize the line items of the trial balance and see that have we missed out on any of the part that needs to be reported and we didn't. That can be identified through the trial balances. Why trial balances? Any income that was missed can be reported in 3B. Any purchases or ITC that was supposed to be claimed and we didn't claim, that also can be reported by identifying in the trial balance. Any expenditure on which reverse charge was applicable, we did not pay or reported in 3B, we can identify such RCM and then we can discharge it in the return and close the return accordingly. I am of a firm view that we must give all the effects, all the relevant effects in the returns of a particular financial year in a particular financial year only. If you are working on 21-22, ensure that all the respective references reporting is done in 21-22. We do not want a spillover effect, because more the spillover effect, more the reconciliation needs to be done. If you do not have any option and you are done with all your returns of 12 months and then after you recognize something, then though law is offering you a period up to September of the following year to do it, but ensure that minimize this spillover effect to have a proper reconciliation to it. HSN code, everyone knows last year a notification came into picture that if your turnover is less than 1.5 CR, you have to report 4 digit. If it is between 1 to 5 to 5, you have to report 4 digit. And if it is more than 5 CR, then you have to report 6 digits. But as far as export is concerned, you have to report 8 digits. Updation in GST registration. I think this registration certificate is something which is left to give importance, or it is left to give attention on it. We do not really give attention to the registration certificate. When a client says that I want to obtain a GST registration, we are very happy that a new client has come to my office and we'll get the registration professional fees. But after that, once the certificate is obtained back in 2017, and I'm damn sure that if you download that registration certificate, there will be no amendment done, even though there was required to be done. Partner is changed, address is changed, bank details are changed, HSN code is changed. So timely, we must really update our registration certificate as well. So I would say this is also one of the year-end important complaint that needs to be done. While doing the migration or while doing the obtaining of the registration, if there are 5 directors, we usually add 1 or 2 directors and obtain the GST registration. So that is not how we really approach this particular format. Opt-in, opt-out composition scheme. If someone does not want to stay in the composition scheme, they can come into regular, so they have to opt out for it. And if someone want to opt in for the composition scheme, then they have to file CMP 02. Opt-in or opt-out QRMP scheme, that for a particular quarter, whether you want to file quarterly or whether you want to file monthly. For composition scheme, it is a yearly approach or yearly options available, whereas QRMP is something we will have a quarterly options, that for one quarter we want to file quarterly, for other quarter we may file monthly. So there is an option available there. Next slide, please. So this is an indicative list of parameters. I guess recently only a instruction was issued by the department that as far as 17-18 is concerned, these are the indicative list of parameters that needs to be ensured, and this will be taken as a criteria to issue a scrutiny notice. So I'm not going deep into this thing due to the paucity of time. There is an instruction I would like to get it noted by you, that instruction number 2/2022 GST, annexure B of that instruction. They have given the indicative list of parameters of scrutiny, so that if you do not ensure that these parameters matches, or these parameters are reconciled, or this parameter needs some attention, if it is not done so, then you may end up getting scrutiny notices and you have to respond it accordingly. So 3 of my slides is for the indicative list of parameters for scrutiny: outward supply, RCM, input tax credit, so on and so forth. Ma'am, can you come to the recent judicial pronouncements? So what I have discussed till now is the year-end compliances and the required reconciliation that needs to be made by us as a practicing chartered accountant as a delivery services to our client. Because only filing returns will not create a value addition to the client. We have to identify the gaps and we have to fill that gaps. That will create value addition to the services. We all know that in our office, the returns are not filed by us. It is filed by our employees, who is either inter CA, who is either BCom or NCom. The client does not come to us for filing of returns. It comes to us to get a time-to-time guidelines, advisory and consultation. Filing of return is just a complimentary service to the client that we are providing. In order to justify our degree as a chartered accountant, we are not here to file returns. We though help them to file the returns, we give it them as a complimentary services. The services that actually we provide is the guidance, it's the advisory, it is their consultation, it is the correspondence with the department, it is the licensing that we do with the department. So these are certain year-end compliances and reconciliation that we really should undertake and really provide a value addition to our services for the clients. Now coming to the second portion of my presentation, which is recent judicial pronouncement. So I will try to cover the there are many recent judicial pronouncement, but I will try to cover few of them which has a relevance in our day-to-day practices. So first judicial pronouncement that I'm going to refer is an advance ruling by the state of Gujarat, wherein the applicant is engaged into printing of mark sheets, barcode systems, unique codes, OMR sheets, and these services are provided to the educational boards of the state. The educational boards are responsible to conduct the examination of 10th standard and 12th standard. And these are termed as the educational institution. The question before the authority was that whether the applicant who is dealing into all these ancillary services of printing OMR sheet or barcode or QR code or barcode stickers will be eligible to avail the exemption for the services provided to such educational boards who conducts exams of 10th and 12th. The authority held that the applicant will be eligible for the exemption. Why? There is a serial number 66B clause 4 of the exemption notification 12/2017 which says that if you provide services to educational institution in reference to the services relating to admission or conduct of examination by such institution. So here the applicant is performing the services which are in references of the examination conducted by the educational institution. There is a proviso inserted in the exemption notification which says that for the limited purpose of examination, the central educational board or the state educational board will be termed as educational institution. So this applicant was providing services to Maharashtra State higher and second higher educational board, and this particular board were conducting the examination, and for the conduct of the examination OMR sheet and the answer sheet got printed by the applicant and served to the board. So under serial number 66B clause 4, services to educational institution. So they have provided services to educational institution, which is the Maharashtra State Higher and Secondary Higher Educational Board, towards the conduct of the examination. The second pronouncement will have a lot of importance in our day-to-day practices. Here the applicant is a manufacturer of API and drug, mainly into medicines. The company was offering a facility to their employees of a canteen, wherein the arrangement was done in a way that a third-party vendor will come to their factory, will prepare the food and will deliver it to the employees. Over here, the applicant were deducting partial amount from the employee's salary for availing this canteen facility. So the applicant and the employees got into a contractual agreement that out of the total CTC that we are offering, the amount towards canteen services will be deducted from your salary. And this particular deduction of the amount will be directly paid to the canteen service provider, which is a third-party vendor. So the question before the authority was that whether the applicant who have collected the partial amount of canteen charges from the employees will stand taxable or not. The authority held that as there is no supply of service involved, there shall not be any levy of GST. The service provider is the third party vendor who is providing the canteen services. The applicant is neither involved into this business of providing canteen services. The applicant over here is the recipient and the beneficiaries are the employees. And this transaction has taken place within the contractual agreement which have been entered between the applicant and the employees. It is just a mere arrangement of remittance from collecting the amount from employees and giving it to the vendor. There is no profit retained by the applicant, and henceforth it was held that there shall be no GST on the canteen charges collected from the employees. Next slide, please. So this is the recent AAR of Gujarat at the appeal level, which came in December 22. This has a lot of importance for a company who is dealing into multi-verticals. The applicant was dealing into two products. One is the gold and silver bullion and one is the castor seed. The applicant purchased the gold at the rate of 50,000 per 10 gram. After 2 months, he sold this gold at 48,000 per 10 gram. So ideally what has happened that he has sold his gold bullion at a loss of 2,000. Now this 2,000 is a loss for the company, and eventually this might end up into accumulation of input tax credit, because as there was no value addition, the input tax credit stays there. So if you got a credit of 1,000 as an input tax credit, and on your output you have to only discharge 800, there is a net accumulation of credit of 200 in your electronic credit ledger. Now the applicant was also anticipating in selling castor seeds. So what the applicant framed that I'll purchase the castor seed from a farmer. So that particular transaction will not have any GST. While selling that castor seed in the open market, the applicant will charge the GST. The question before the authority that came that whether the 200 rupee that is accumulated on sale of gold bullion, which was done at a loss, and due to that loss, there is an accumulation of ITC on account of sale of gold bullion, whether that particular ITC can be available to be utilized towards the liability of the castor seed. So this was the categorically question before the authority. The authority held that once the credit is credited to electronic credit ledger, there shall be no recognition available into it. Once it gets deposited into pool of credit, then it can be used towards any of the outward supply. They held that we note that section 16(1) of the CGST Act only states the eligibility and the condition for taking ITC. It does not impose any restriction on utilization of legitimate earned ITC. So if you have earned the input tax credit in your electronic credit ledger, and which is legitimate and which is lying in your electronic credit ledger, and tomorrow morning you have a new business, even that credit can be utilized towards your new business. There is no nexus with outward supplies required. So the fact, can you come back to the next slide, please. So over here, this particular ruling is helpful to whom? Who is running a multi-product market or a multi-product malls. You take example Chroma, you take example of Big Bazaar, you take example of Central Mall, you take example of supermarket. So all the example that I have given, they have 100, 200, 500 sort of products. So once, while procuring these 500 products, you have to ensure that section 16.1 is complied. And once section 16.1 is complied, that particular input tax credit on the purchase of these 500 products gets deposited into electronic credit ledger and it becomes pool of credit. Then there is no identification required that if you have bought AC, then the credit of AC needs to be utilized against AC only. That is not so. If you have credit of air conditioning in your credit ledger, you can very well utilize that ITC towards the outward supply of mobile phones. But this does not need to result into a malified practice wherein you take an invoice of AC and then you raise the invoice of mobile phone. What is that? There should be a stock of air conditioning. For example, currently summer is going on. So there would be a lot of sale of air conditioning. And the supermarket is also having some winter jackets currently there at store, though it is not the season, but they already have it there in the stock. So it may happen that on these winter jackets, there is an ITC which has been credited in the credit ledger. So very well, this credit can be utilized toward the sale of air conditioning in the summer season. Actual purchase should have been taken. So what I'm trying to say, once section 16.1 is fulfilled, then there is no identification of credit is to be done. And ITC can be utilized towards any of the outward supply. Second is in case of GSEL, Nalco, Alkalis and Chemical Private Limited. So actually this case has been referred into a lot of states and even in some of the appeal levels, that ITC is not eligible on leasing charge of land to be used for construction of factory. For example, I've taken a land on lease and I am anticipated to construct a factory thereupon. So whether the lease charges that I have paid for that particular plot or for that particular land, whether it will be eligible if I'm constructing a factory on that particular land. There is section 17.5 clause D which says that goods or services used for construction of immovable property is not eligible. Now, can we say that whether land is used in construction of immovable property, whether the lease charges that has been paid towards the land, can it be said that this particular land is being used for construction of immovable property? In my personal view, the answer is no. The question is not that whether factory can be performed on that land. The question is whether land is used for construction of immovable property. My answer is no. Though the authority has denied the credit of these lease charges by stating that this lease charges of the land that you have paid is used for construction of factory. What can be used for the construction of the factory? Steel, cement, raw material, sanitation, pipes. So these are the items that are really incorporated in constructing that immovable property. So in my view, the credit can be eligible on the lease charge paid on the land as it is not hit by section 17.5 clause D. Next slide. E-commerce operator. I guess we really have few clients who are dealing into e-commerce operator because there are not lot of people who are engaged into e-commerce activity. You have heard of rent-a-cab service of Ola and Uber. So this particular question is similar to what the Ola and Uber people do. So just to give a fact, the applicant is an e-commerce operator having a mobile application. On that mobile application, the customer will come up and book a ride. And once the ride is booked, the e-commerce operator will instruct the driver that kindly pick up this customer from this place and drop him on the another place. If you are aware that if you book Ola or Uber, while booking only, you will get the price as well, that these are the ride charges that you are supposed to pay. So while booking the ride, I get to know that the charge for this ride from one place to another is 100. The app says that if you want to get a discount, kindly apply this coupon code. And if you apply this coupon code, you will get a discount of 10%. So your net effective price come down to 90. So I pay 90 as a customer to e-commerce operator. And then after e-commerce operator apportion that amount to the driver. Because ultimately the transaction is happening on the app and your driver is also giving the services to the e-commerce operator and the e-commerce operator is giving services to the customer. The customer is unaware who is the driver and the driver is unaware who is the customer. The very question before the authority that came into picture, that e-commerce operator is collecting 90 for the ride charges from the customer, but e-commerce operator is paying the original price of ride charge to the driver. Driver says that whatever you want to give the discount, you give to the customer, but I will charge 100 from you. So what the driver says that you charge 90, that is not my lookout, but you have to pay me 100 because this is the service charge that I am giving. So the question before the authority was whether GST needs to be paid on 90 or on 100. So the authority examined these facts. There is section 9 subsection 5 which says that a passenger transportation services is conducted through an e-commerce operator. In this case, the driver is not supposed to pay the tax. The electronics commerce operator will be deemed to be the supplier of service and will be deemed to be a person to discharge the tax. So what the authority held that instead of 100, the tax needs to be paid on 90. Section 15, subsection 3, clause B, that if the discount is offered on the face of the invoice, that is deductible, and on 90, the liability needs to be fixed, even though you are paying 100 to the driver. The another ruling is with respect to a double layer of Tamil Nadu, which says that GST is payable on the renting of property to a firm by its partner even without consideration. So there is section 1 clause A read with schedule 1 which says that if the activity is happening between two distinct person or a related party where there is no consideration even though the tax is leviable. So if a property is owned by a partner and it has been rented to 10 other companies and in all 10 companies the owner of the property is a partner or a director, this will be deemed to be an activity under entry 2 to schedule 1, which is a related party transaction, and either you pay the tax on the notional amount or you pay the tax by offering a rental agreement. So even though there is no consideration involved in this transaction, even though this gets taxed as per schedule 1. Next slide. So this is also one of the burning issue we had in service tax regime, which is notice pay. The applicant is a pharmaceutical company and they have got into a contractual agreement that they will recover the amount towards notice pay from the employees for not serving the notice period. The contract between the applicant and the employee says that if you want to resign from my company, you are supposed to fulfill a 3-month of notice period, then you can leave the company. If in case the notice period is not served by the employee, the contract says that the period not served will be deducted from your salary and will be retained by the company. Over here, the resignation by the employee does not need any approval and he is free to have a resignation by tendering it and he can leave the company. And if the contract says that if they do not serve the notice period, you can deduct the amount of the salary. over the authority stated that there is an entry 1 to schedule 3 which says that employer-employee relation is outside the purview of GST. There is also an entry in schedule 2 which says tolerating an act or forbearance an act, that you are tolerating your employee of not serving the notice period. On that aspect, the service tax regime had a liability that also got nullified. So what the authority held, that there is no forbearance or there is no toleration by the employer, because the employer and the employee is acting as per the contractual agreement. If it has said that contractual agreement says that so and so, and you did not comply with that so and so thing, then toleration or forbearance comes into picture. The contract already says that if you do not serve, we'll deduct the amount of salary, and if you fulfill the notice period, there should not be any deduction. So schedule 2 will not come into play, and it says that this activity is a part of a employee-employer relationship under the employment period. So the authority stated that there shall be no GST on the notice pay recoveries made from the employees on account of not serving the full notice period. Next slide. So the Madras High Court in one of the case held that there shall be no reversal of the ITC for the loss of input during the manufacturing process. So it may happen that there are certain items which gets absorbed during the process of manufacturing, that by putting 100 kilos into the shop floor or into the manufacturing activity, it is not necessary that it will come out 100 kilos only. It may happen that due to some of the normal loss during the process, you may get 98 kilos by putting 100 kilos. So the authority, the Honorable High Court held that for the 2 kilos that have been considered as a normal loss during the process of manufacturing, to that extent you are not supposed to reverse the credit, because there is one entry 17.5H which says if the goods are lost or stolen, then you are supposed to reverse the credit, or which happens to be a block credit, that if the goods are lost, then you have to reverse the credit because it is a part of block credit. The Honorable Madras High Court stated that this loss is an acceptable normal loss during the manufacturing process, and the loss that has happened during this particular process need not be offered for the reversal of input tax credit. So if you come across any of the manufacturing activity that by putting 1000 kilos you only get 995 kilos and there is a 5 kilos of manufacturing loss, then ITC does not need to be reversed. In the recent pronouncement by the Gujarat High Court, that intimation given in form DRC 01 is not valid and it should be in form of DRC 01A. As all of you know that section 73 and 74 is for the demand and recovery aspect. In order to adjudicate any matter, a show cause notice needs to be offered, and then after the adjudication takes place. And before issuing show cause notice, there is one form called DRC 01A, which is an intimation form, that if you pay so and so liability before the issuance of show cause notice, then you will be only offered to pay 15% of the penalty. So in this particular case, what the department has erred, that they have written the subject as intimation under the form of show cause, which is DRC 01. Everyone knows that show cause notice is issued under form GST DRC 01, and intimation needs to be given in form GST DRC 01A. So an interchangeable thing had happened by the Assistant Commissioner of the State Tax, and this particular intimation, the word intimation was supposed to be written under DRC 01A, but it was given under DRC 01, and DRC 01 is a show cause notice. And under this particular show cause notice, the Assistant Commissioner also erred in giving the assessment order, because the assessment order needs to be given in DRC 07. So there was a lot of mix and match which took place in this particular matter. So the High Court has quashed this particular order in DRC 01A, though DRC 01 is a show cause notice, but DRC 01 framed by the assistant commissioner was in form of an assessment order which got quashed, and it has been requested to the assistant commissioner to kindly re-carry the adjudication matter. Third is the ITC is not eligible on the business promotional expenses for personal consumption. So there is a lot of time it has happened that if you have a dealer or a distributional channel business, you offer that if you close to this amount of target of turnover, you will be offered gold coins, or you will be offered a motorcycle, or you will be offered some or the other benefits. So usually these expenditures are taken into a business promotional expenditure head under profit and loss account. So what the authority held that the purchase of gold, silver coins which are distributed to distributors or dealers, or offering a motorcycle to the dealers who have closed or clocked the target turnover, that ITC on so and so much purchase will not be eligible, as this is for the personal consumption. It may happen that in Diwali also we usually give sweets, dry fruits to all of our clients, customers. So even the credit on that amount is not eligible. That was held in this particular matter. Next slide. So this is the last ruling that I'll be leading up to before closing my session, that any of the order needs to be a speaking order. Merely issuing an order by reflecting the amounts will not be recognized as an order under the law. If the order that is issued to any of the taxpayer, and if it is non-speaking, there are no reasons which are mentioned for the amount quantified or the amount raised as a demand, then that order will not be recognized in an order of demand under the law. This was quashed by the Honorable Gujarat High Court in case of MP Commodities Private Limited. So I guess the slides are. Can we get into the next slide? I think the slides are over now. Okay, so I will try to justify the topic to that extent of the year-end compliances, reconciliation, and recent judicial pronouncement. Once again, I'll thank both the branches for the wonderful opportunity, and hope it came well to the expectations of the participants, and looking forward to such more webinars and sessions with both the branches. And I really appreciate the hard work and the efforts which are taken by the branches in the interest of the members to really provide day in, day out sessions in indirect tax or direct tax, or for that matter other subjects, which really creates an interest for the participants and which will really help them into their day-to-day practice. And these sessions which are being taken up by the branches is really creating a value addition to the clients of the practicing chartered accountants. And I'm also thankful to all the participants for the patience hearing. And if in case you have some queries, either we can have it over here, or my mobile number and the email ID is also displayed on the screen. And if someone want to have a discussion on any of sort of a query under GST, you can either drop a call or drop an email on this email ID. Thank you so much.
Thank you, sir, for providing us deep insight into the issues and it dispels many doubts. Now we have come to the end of the session. Now I request CAS Kumar, Secretary of Salem Branch, to give vote of thanks.
Good evening, members. And at the outset, I'm very happy to propose the vote of thanks for this wonderful session. And I'm sure that all the participants will definitely agree with me that the developments, whatever is happening on the GST front, has been well addressed And I'm sure all the insights, whatever has been shared, will be definitely play a very important role in the day-to-day practice of all the members. At the outset, I would like to first thank the Pondicherry branch chairman, CA Manjupashini ma'am, the secretary K. Ranjit Kumar, and the ex officio member of Pondicherry branch, CAR Sundararajan sir. And I would like to thank also our chairman, CABA Shankar, and the office bearers of Salem branch. We all collectively would like to thank definitely Devam Sheth for your wonderful session today. We are really delighted, and we would like to definitely have you sometime soon live. Yeah. So the kind of insight what you have shared will play a very important role. The pronouncements and year-end planning related aspects and everything, whatever shared in last, it's like I would say probably the 2 hours. I'm sure members did not even realize that 2 hours have passed. So to that extent, the number of things have been addressed, and I'm sure this is definitely a value adding session for all the members who have been present, and we are so happy and very kind of you for the support you are extending all the way from there, and big thanks to you. And I would like to thank the office bearers of both the institute, and thank you all, one and all. Thank you.
Actually, I shall be thankful to the branch rather than you being thankful to me.
Oh no! It is, we are very humble, but believe me, it's I'm sure that whenever we conduct a GST session, always irrespective of the timing, 4 to 6 in our place is normally a tea time. Okay, okay. At that point in time, seeing a Zoom meeting with 60 plus members is not a joke. Definitely, it adds enormous amount of value, and we are very happy to have those many number of members at that point in time. So I'm sure that
the only aim that I have for my fraternity is that we, being the chartered accountants, we should not be compared with any of other compliance officers or any other compliance consultants.
True.
See, even in my office, or for that matter in your office, it would be the people who have graduated BCom or NCom, or for that matter inter CS, would be doing the compliances.
True.
A client should not come to our place for getting returns filed. A client should come to our place for the guidance and the consultation. That is where there is a clear role of a chartered accountant. All of us who have worked hard all the 5 years by completing 3 years of articleship and getting a very important degree, which is really helping us to run our homes. It is, the CA degree is something which is helping us to run our homes, right? So after doing so much of hard work, getting this degree, we should be justifying our degrees by not performing that we also file the GST returns or income tax returns, because otherwise MCom or BCom should have been sufficient for us if we were supposed to file returns only, right?
Very true.
So the only aim that I have for all my fraternity brothers and sisters, that we should really keep our good work, we should really increase our bars, we should really increase our level by really serving to our clients. The client should say that I have a chartered accountant who really gives good advices and consultation. They should not refer us that one of my consultant is good in filing returns. We don't want to be good in filing returns. You want to be good in giving advices to the clients, because that will create a path for them to really run their businesses. And furthermore to it, see, I am very younger to all the participants currently. It's hardly 5 years that I have come into practice. what I have also observed, this is my personal view, that we usually charge less amount of professional fees to our clients. We are not getting paid for the consultation and the advisory. That is on phone calls or it is on email. Whenever they wish, they come down to our office and sit in front of us. They are least concerned whether we are busy or not. So even the professional fees that we really charge, we need to justify our services and then charge our professional fees to them. I think I can tell for I'm sure that I can tell for Ahmedabad, they do not give us professional fees for the advices that we give. They only give professional fees for the returns that we file per month for them. Advisory and consultation is free. They seems to have a birthright that we can ask advices and consultation for free from the consultant.
No.
So this is the gap that we really need to fill up.
Actually, Dev, I would like to probably share something here. Personally, I agree with you more than 100%. And when it comes to our practice in our firm, even for phone consultation, I send a bill. So
absolutely.
And there was one time, I even wanted to speak on for almost 2 hours on how to bill.
I think with that subject, you'll be getting full of the participation.
Yeah.
That is also an art.
So,
that is also an art.
Yeah, absolutely. This is something where we should be really, trained. So I think at some point in time, I'll be definitely addressing the members on this. Okay.
Do let me know if you do some sessions on this.
Sure. Yeah. Wonderful having you here.
Same here.
I had sir, sorry for interrupting you. I had an experience. One member who charged 2,000 rupees bill for the description is like, I took 2 minutes to read your mail, charges 2,000 plus GST applicable. It's okay. It's all in the thing, right? Yes. Anyway, so please continue.
So it was wonderful connecting with both the branches, because it hardly happens that we have an outreach beyond the state of Gujarat and get an opportunity to connect with the people that we usually do not meet. And very glad to really have views from the learned practicing chartered accountants at the branches.
So nice.
Don't worry, we will call you personally. Kuntal Shah has come 1 month back.
Sorry?
Kuntal Bhai has come. Kuntal Shah.
Okay.
So surely both Pondicherry and Salem branch will call you personally, sir, for a wonderful session.
Yeah. Thank you so much. Thank you so much for having me.
Okay, right. I'm done from my side. Yeah. Thank you so much, Dev.
Yeah.
Thank you all.
Thank you.
Thank you, madam. Thank you, sir.
Thank you, sir. Thank you.
Thank you. Thank you.